Good afternoon, everybody, and welcome to the Realistic Real Estate Wrap-Up. We've been running this series going on 7 weeks now, and we've got 5 fantastic speakers that have volunteered their time and expertise to come on over the last 7 weeks and share with us some investing strategies, tips, ideas as it relates to real estate. And our goal being, let's focus on stuff that's realistic, that everybody out in the marketplace can participate in some way, shape, or form. So I'll start with a huge thank you to each of our panelists today for taking the time and sharing their knowledge for all of us. Today is the culmination of those presentations wrapped up into one group event. This is meant to be a Q&A and a forum for questions from the audience to be asked for us to walk through and talk through. So we've got a panel of experts here that cover just about all bases of real estate in so many different capacities. So we're going to open up the floor for questions throughout the next hour or so. If you do have questions, please get them typed in onto your screen there. That way that we can see them on our end. Same thing if you're watching on socials, please get those questions typed in. Those will pop up on our end as well, and we'll do our best to get to all of them. We've got a pretty long list of questions that's already come in through the classes that we did over the last 7 weeks, so we'll get right into it. We're going to do some just quick introductions. I'll let everybody kind of formally introduce themselves. So, Whitney, we'll start with you. If you want to let the group know who you are, who you're with, and what you do.
Yeah, absolutely. My name is Whitney Elkins Hutton. I'm the Director of Investor Education here at PassiveInvesting.com. And we are a private equity firm that invests in multifamily, self-storage, car washes, hotels, and first position real estate debt, primarily in the southeast part of the United States. And we focus on cash flow, tax diversifications, and equity growth.
Wonderful. Well, welcome, Whitney. Thank you so much for being here. Bryce, you're up.
Hey, thanks for the introduction. I'm Bryce. I'm the Vice President of Anabasis Equity Partners. We're a small investment fund based in Jacksonville, Florida, and we focus on single-family, multifamily, and self-storage investment properties, raising capital as well. I'm also the broker and owner of Anabasis Realty, and we do traditional real estate and investments as well.
Wonderful. Thank you, Bryce. Appreciate it. Miss Carrie, you are up.
Hi, my name is Carrie Cook. I'm the president of Ignite Funding. We specialize in trust deed investing, which is collateralized real estate investing to our investors, primarily in the Western United States. So we are debt financing. That's about it.
Thank you, Carrie. Welcome. Mr. Alex.
Hey, my name is Alex Casada. I am the owner-operator of All Steel Storage. That's my main focus. We bought 8 self-storage facilities in the last 2 years, all by raising money from private investors to partner with us on these deals. And I also own some other multiple companies, a wholesale operation, and also a call center in South America where we employ over 200 people.
Cool. Thank you, Alex. Matt, last but certainly not least.
All right. Hey, everybody. I'm Matt. I am the founder of Maverick Investor Group. We are a real estate brokerage that helps you buy turnkey rental properties in the best U.S. real estate markets from anywhere. So you buy the actual physical house, you own the deeded real estate, but it comes fully renovated with tenants already in place, so you don't have to be the rehabber or the landlord.
Thank you, Matt. Well, as you guys can hear, we've got a lineup that really runs the gamut from residential real estate all the way up to every product line under the commercial umbrella of real estate, as well as on the debt side and the brokerage side. So we've got all bases covered here. So I've got a list of questions. We'll go through them in no particular order. But the first one, and I have to say this one was pretty intriguing question when I read it. And I think this one's going to go to Whitney, but we'll certainly open the floor up. This one was specifically around car washes. And the question reads, how do you underwrite and account for potential outages, equipment maintenance, downtime, and repairs for any car wash facility?
Yeah, definitely. Thank you for the opportunity. So when we're underwriting our car washes, I mean, first of all, majority of our car washes, we're actually acquiring them previously from mom and pop owners. So this is a really unique opportunity to start consolidating what is known as a fractionalized space. So it harkens back to self-storage in 2008, 9, and 10. With that, we generally have the profit and loss statements, trailing T12s of these previous owners. And, as we're going through the due diligence period, we do understand what the condition of the current equipment is. And so combined with historical data, as well as our projections for the life of the current equipment and what equipment needs to be replaced initially during takeover, we can actually, get a really good scope of what needs to happen. Now, majority of our acquisitions, if a piece of equipment is already worn out, we are building out a CapEx budget to already go ahead and replace that equipment so we can perform a cost segregation analysis in the first year of that hold of the asset and go ahead and accelerate the depreciation of the asset. There isn't really much, reason for us to, pump much more life in a piece of equipment that's, end of life. So, we'll go ahead and replace that. And one, that allows us to capture that loss, but two, also, provide just a better customer service experience for our clients that are utilizing the car wash. So hopefully that gives some insight on how we're doing that. But the way we have done, all of our underwriting, we really tried to, get everything, the CapEx underwritten upfront, so we know what those issues are and we get those taken care of at the very beginning of the hold of the project.
Thank you, Whitney. And I'll open up the floor. I know car wash is a pretty unique item, but any translatable underwriting considerations and any other asset classes that may be comparable and add some color to that answer. We'll open up the floor. If not, we'll keep moving.
I have a question for you, Whitney, actually. Yeah. So I'm actually looking at a self-storage facility that has a car wash up front, and they don't have their financials together. Is there like an operating expense typical for a car wash?
Yeah, like so majority of the car washes that we're looking at from, mom and pop owners, their OpEx typically probably runs somewhere at 55 to 60%. They might actually say that it is 45 or 50, but we tend to add like a buffer on top of that because, like it or not, maybe you've experienced this in the self-storage space, financials aren't the best kept. Yeah. From sure. Those type of owners. But yeah, I would always add a buffer on top of, what you see from their financials if you do get them.
Perfect. Thank you.
Yeah, and you make such a great point, Whitney. I think everybody here would agree. If you've underwritten a deal, you've had to look at some financials and scratch your head and wonder, how is this business or product, real estate been operating this long with this kind of condition of their financials? But I suppose when you see that, it's a good sign that there's some real value add somewhere inside of that. I'll make one other good point or one other point. You guys, I suppose, can decide if it's good. But, I love hearing our panelists ask each other questions. It says a lot about Alex and his willingness to go out and say, hey, I don't even know that. But there's some pros on here that do. So thank you for question one, already knocking that out. So let's keep on moving down and we'll start this next question. And I think we'll start, Carrie, with you as it relates to interest rates. And it's a two-part question. Number one, how is rising interest rates both benefiting and maybe creating challenges in your day-to-day business line? And then number two, does the rising interest rate actually create better profit as a lender, or does it create harder challenges? So a little bit of a two-part question, kind of reading the way that it came in. But if you can decipher that and kind of maybe walk through what this current interest rate environment looks like and how you guys are navigating through that.
Yeah, the interest rate environment, as far as let's take it twofold. Let's talk about what you have in your portfolio, because our portfolio is so diverse. About 18 months ago, I started moving our portfolio out of entry level home buyer product, because those interest rates obviously affect that buyer much differently than it affects a multi-million-dollar home buyer. And so we certainly started making that evolution and that move about 18 months ago. So very little of our portfolio is still housed in that area. So risk, if we're removing risk from our investors, that's how we do it. that interest rate from a debt perspective of what we're charging has also been somewhat affected. I say somewhat affected because when the interest rates were at 2%, I was still lending at 12s and 14s, right? And now the interest rate gap is closing on us, and I'm still at the same rate, which some people have questioned me on. Carrie, why aren't you moving your interest rates and ratcheting them up? Well, that's because we're working with the same borrowers. And sometimes, we have to watch and see what's going on with the market. We can't lead with fear and say, well, because everybody else is doing it, we should do it. These are borrowers that have worked with us for more than 10 years. They've come to expect, the way we act is not based on leading with fear. It's based on, leading with what's important to make them successful too. This is a two-way road. When you lend to borrowers, you can't harm them at the same time, or they're not going to make their interest payments. Therefore, our investors are going to be harmed. Therefore, we're going to be collecting on a lot of properties. And we're not in the game of collecting on properties. Although we do it, we're not in that game. So will there come a point where we start to see it, just get so close that we need to start making some moves? Maybe. We kind of have to wait and see what happens here. I think, my opinion is we're going to see another slight increase, and then we may stable off and we may start going in the opposite direction. Now, how silly would that look if I'm raising my interest rates and, 2 months later, they decided to start taking it in the opposite direction, right? So you have to be patient, I guess is what I'm trying to say to everybody that's out there. Don't harm your borrowers by, jacking up the interest rate, because you're harming your investors at the same time.
Well, that's certainly great feedback. Love that last part about don't harm your investors. Ultimately, they are the customers, and I really appreciate hearing that. Let's maybe turn that same question out, since the rest of the group is typically on the borrowing side of debt. What are you guys seeing in the marketplace? How is it impacting underwriting both today and I think maybe going back to Carrie's thesis that, we're all kind of feeling that maybe we're hitting the tip of the iceberg here. Maybe we're starting to feel like there's some relief on the other end. Maybe Bryce, we'll start with you and kind of shift gears over. How are you, or what are you guys doing from an underwriting standpoint, and how is interest rate potentially slightly rising and hopefully, working its way down, impacting your underwriting today?
Well, I think from a private money standpoint, I've actually started to see the rates come down a little bit on fix and flip loans, long-term rental loans, multifamily loans, things like that. I've seen it come down anywhere from 55 to 75 basis points here within the last couple of weeks. So it's been nice to see those come down. Obviously, when you're working with leverage, you want to see the cash on cash returns be around a certain point whenever you're working with debt. So it helps in acquisitions. Obviously, whenever the interest rates were going up and up and up, it's changing the entry point and the price point that you're able to get into different acquisitions and different deals. So I think for a long time there in the market, here in the last few months to a year, there was a really big discrepancy between the seller thinks that they can get this because of 2021 prices, but they don't understand as the interest rates continue to go up every quarter that the prices at which investors and other players in the game are going to be able to pay is getting lower and lower. So it seems like we're starting to see the curve flatten a little bit as far as prices moving down and interest rates flattening a little bit. So I see some promise in the market going into the future.
Well, that's a great perspective, Bryce, and certainly always love hearing. Maybe we're feeling it even ahead of when the overall markets feel it. And as investors, we always have to try to be a step or two ahead of the general marketplace. Matt, kind of maybe staying on the residential side, what are you seeing in as you guys are identifying product to help from a rental standpoint? How is it impacting your investors, rental returns? What are you seeing, Matt? And are you seeing something similar to Bryce in terms of a flat line or even possibly some reduction in some of these historically higher rate loans?
Yeah, so I think there's a number of things with regard to interest rates, right? So all of our clients are buying single family rental properties. So they're getting conventional mortgages, 20% down mortgages, 80% financing, right? And that's sort of what they're getting. And we point out a few things about the interest rate environment today that a lot of people don't necessarily think about, right? One is I show people a 50-year chart of interest rates. And I explained that even though we have ticked up over the last few years, we are still historically incredibly low in terms of what rates are today. So first of all, contextualize it over the last 50 years. The second thing is that we teach our clients about how to adjust for inflation. Okay. So when you're talking about real interest rates, right, and you take today's interest rates and then you subtract today's rate of inflation, now all of a sudden, right, you're actually lower than you were 2 years ago in terms of the real inflation adjusted interest rate. The other thing we explain to folks is that when you take out a mortgage, you are borrowing that mortgage in today's real dollars. And then as inflation kicks on, you're paying the bank back in future diminished nominal dollars that are worth less than the ones that you borrowed. So instead of inflation destroying your wealth and your buying power as it does when you keep your money in a bank, if you have a mortgage on a rental property, instead inflation is working for you and it is destroying your debt, right? So we sort of contextualize all of these things for our clients. The other big impact that these rising interest rates are having on the housing market in general is that it is causing borrowers who own houses already, and they already have a 30-year fixed rate locked in, it is causing them to keep their homes off the market. They do not want to sell because if they sell, they lose the mortgage. And then they got to buy another house and they got to have a much higher interest rate on their mortgage. So they realize that that mortgage note, that 30-year fixed rate mortgage is the asset. So they want to keep it and preserve it at all costs. So they're going to keep their home off the market. That further reduces supply and further helps to drive home prices up, which of course benefits investors. So that's some of the context that we giving our clients.
Well, what a great perspective, and one that not many people tend to talk about. It is amazing how mortgages today are actually driving the ship on real estate. And I love what you said. It's actually the asset, right? They don't want to sell the house. They're willing to part ways with the house and find another box to live in. But that mortgage has actually become the real bit of gold. So, and then I can't help but I saw a ton of nodding heads when you talked about historical interest rates. When you're in real estate, you're well aware of cycles and history. Everyone outside of that is very short-term memory spans. They want to remember to the last point that they can make the best argument against. And, if you take away a 6 or 7 year period of really cheap money, interest rates have always been north of 6 and 8%. So people are buying at a pretty good discount today. Any other comments on kind of the rising interest rates and what you guys are seeing? Alex, Whitney, maybe we'll start, Alex, with you. What are you seeing? And then Whitney, you can bring us full circle on this one.
So on the storage side, we're seeing sellers still wanting the prices from last year, and the terms with the lenders, nothing really pencils out. Like, you can't make these deals work. You can't buy at a 5 cap when the lending's at 6.25, 6.5. So the deals don't work out unless there's tremendous add value. So what we actually have been able to do is a benefit to us is, a lot of the times sellers have been contracted with a buyer during these times of the interest rates rising and not being able to get those loans through. So a lot of sellers have had buyers back out of deals. And so we've been able to structure deals with creative financing. We just got a deal under contract at 5.5%, 5.5 million, 85% seller financing with 3% interest amortized for 30 years in a 10-year balloon. So amazing rates that we can negotiate now, paying a little bit slightly above maybe what they were asking, but paying that upfront and getting better terms on our deal allows us to cash flow tremendously and allows us to have greater cash on cash returns than if we even had that 4% rate from the bank 2 years ago. On the single family side, because we have a single family operation here that we do like 20-30 houses a month, we actually are seeing a lot of people a lot more people who are actually feeling the pain of what's going on in the market. And taking deep discounts on their houses, being willing to negotiate to sell their property, and realizing, hey, like this is the best price I'm going to get right now because it's still trending downward. And so we're actually being able to get a lot of good deals on the single family side. On the self-storage side, I think it's still, we got some time until we have sellers realize that what's changing with the terms in the banks.
Well, it's interesting because commercial and residential, they're so similar, yet they're light years apart. And, I think commercial has benefited gravely from most of the payers across the board. They've been fortunate to see rising rents and rising expenses, whether it's a car wash, a self-storage, a multifamily, and they haven't really felt that pressure. Homeowners feel it first. They're the ones today that they're feeling it when they go to the grocery store and buy a $6 dozen of eggs. And so for them, they're starting to feel that pinch. And we're going to talk about inflation and yesterday's report here in just a minute. So I won't dig too deep into that. But I want to give Whitney a chance maybe to put a bow on kind of the interest rate piece and what you guys are seeing out in the marketplace.
Absolutely. Yeah. And our experience is much like Alex and Bryce's. There's still a gap between what people are wanting to sell their assets at, be it multifamily, self-storage, even car washes, and what the reality is. But what I wanted to kind of stack on that is kind of a through line that nobody's really, pointed out directly is interest. We can be concerned about the interest rate, but it's actually the type of debt that people should be looking at, especially if you're an investor, a passive investor in a deal. To Matt's point, locking in this interest rate debt, this 30-year fixed rate debt, arbitraging that spread in the rates, that is key. Because what I think sometimes investors do to themselves, to their detriment, is that they're pursuing yield, but also they're trying to, in pursuit of that yield, they put themselves in a debt position that isn't ideal for the actual business plan of the asset. And so we're actually seeing, especially in the multifamily space, that there's probably a reckoning coming here in Q3 into Q4 from investors, operators that have put bridge debt, construction debt on their properties, to get that high to low 3% debt, the end of 2019 going into 2020 and 2021. But that debt runs out in about 3 years. They don't have an interest rate cap. They don't have extensions to be able to float that debt and get through this choppy water environment. So it's not just about the interest rate, it's the type of debt structure as well that people need to be looking at. Not only as a direct operator, but if you're investing in somebody else's deal, make sure that this is not the time to be in bridge debt that has no interest rate cap and zero extensions on it. This is the time to again, like Matt said, invest in the debt that is being, locked in and put on the property.
Yeah, I've actually, ironically enough, read an article this morning on LinkedIn, and it was about debt resetting and maturing on some of the creative debts. And 2019 and 20, you didn't need much creative debt. I mean, debt was cheap, yet there's still a good amount of that debt that was created, thinking that interest rates would never go up or would be in a low rate environment, and they'd refinance as part of their strategy, which, maybe it was poor underwriting, or maybe it just was, seemed so simple at the time. But that certainly will create some opportunities. And I would imagine everybody on the panel here is already, maybe looking forward to some of those opportunities presenting themselves. Let's thank you, Whitney, for tying that last piece in. I think that's a critical one. So let's go ahead and talk a little bit about, Matt, I'll direct this question at you specifically, and then we'll kind of work our way around. On the fix and flip, you brought up, kind of softening prices, and you brought up some opportunities to be on the buy side. How is that market from a fix and flip standpoint, or from a basically get rent ready and sell to the marketplace? Two-part question. One is, what are you seeing on the repair side? From an inflation standpoint, being able to get contractors and vendors in and managing the workload that's associated with that, and then getting the appetite of the buyers that are typically buying these properties, given that the market, whether it be a higher interest rate or some of the things we've already talked about, How are you guys navigating through that, and what tips do you have for folks out that are paying attention to us today on how to navigate through that?
Yeah, so 100% of the properties that we are introducing our clients to are turnkey performing rental properties. And our clients are coming in to buy and hold those properties. So they have already been fully renovated or they're brand new construction, one of the two. And they already have long-term tenants in place on a lease. And they also already have local property management that's in place. It's collecting the rent and handling the maintenance and all of that. So you don't have to do any fixing. And you're also going to not be flipping in the short term, because the benefits, the real benefits from residential investment property come from holding it over time, right? And that's really what our message is and what our clients sort of understand, which is that it's always a good time to buy real estate as long as you buy right and as long as you buy it in the right place, right? And so in this particular moment, in this particular market cycle, we've been doing this for 16 years. So we were doing this before the Great Recession, during the Great Recession, after the Great Recession. We've seen all of the different property cycles, right? And it's always a good time to buy real estate as long as you're buying it right in that particular portion of the cycle. And so right now, there are all kinds of incredible benefits to buying real estate in today's particular market, right? So for example, the available inventory on the market is still incredibly low. It's about 50% of what's typically considered a healthy, balanced market, right? We just talked about why all of these homeowners are keeping their properties off the market, right? So further reducing supply, that's driving home prices up. High inflation environments, the most advantageous investment you can have during a high inflation time is to buy and hold rental property, because inflation pushes your home prices up, it pushes your rents up, and it debases your mortgage debt and destroys your debt. So you profit from inflation in three different ways. The higher inflation is, the more you profit if you're buying and holding a rental property. And so in this particular environment, our clients, we do that kind of education. We support our clients in doing that type of analysis. And then they understand, as long as you can buy a property in a what we call an investor advantaged market, right? I mean, good economic indicators, job growth, low unemployment, people moving in, and you can buy based on real estate fundamentals. So you're buying relatively low, renting relatively high, you have positive cash flow, and you're going to hold that property. Now, all of a sudden, you have 5 different profit centers working for you at the same time. You have market appreciation potential. You have passive cash flow coming in. Your tenant is paying down your mortgage principal every month. You are owning the most tax-advantaged asset class in the United States when you hold residential investment property. You can depreciate the property even if it's going up in value. And then you have this inflation profiting benefit, which is probably the least understood of all of them. And so, when you understand that whole package and you buy right, we encourage our clients to just make their money when they buy, lock in that performing property with a stream of income, and then just allow those 5 profit centers to work for them moving forward.
Thank you, Matt. Anyone have anything to add on that and what they're seeing in the marketplace as far as vendors or having properties repaired or and what that looks like? I think Bryce, maybe you're ready to come in.
I'd definitely like to talk about that. I think a lot of projects that we've seen have come out much higher as far as rehab costs within the last year than we had budgeted for. I mean, some properties going 10, 20, even 30% over budget in the single family space, specifically in the Jacksonville area, just because especially when you're working with some houses that are pre-1940 construction, and you're opening up walls and there's foundation issues. We have wood repair, roofs, the cost of electrical with wiring and things like that has gone up considerably. Also, when you take into account for plumbing and removing galvanized steel piping and getting PVC and if you're working with septic tanks, whatever it may be. So definitely have seen those costs go up. A couple years ago, you're rehabbing houses for 40, 50 grand. Now not so much, probably 60, 70, 80 grand to rehab these houses. To get a good contractor in place, that's a huge piece of the puzzle, because a lot of contractors, want to tack on that, 15, 20% profit margin, and the materials and the labor that they're using that is higher than other contractors may have access to. So really, testing the waters in your market, finding reliable contractors with good sources for labor and materials that get good prices for these things is key for investors going into the future, and getting those repair estimates done up front in your due diligence periods, and really figuring out, with a general contractor or whoever you're working with, what your numbers are really going to be. Because even for really experienced and seasoned investors, you may walk onto a project and think, oh, okay, this one's probably going to be about 60, and it comes back at 75. It changes those numbers considerably. So I think for repairs, that's definitely something that investors should look at into the future, and be mindful of, especially when they're working on older houses or even multifamilies that are pre-1980 construction, especially when you're talking about aluminum, cloth wiring, and redoing plumbing systems, HVAC, roofs, and things of that nature.
Well, thank you, Bryce. And, I think two things that I heard out of that are the key takeaways is, number one, know your numbers. Due diligence is key, and make sure that you're not guesstimating, especially in today's market. But two is vendor management. Make sure that you have the right vendors and that you retain the right vendors, because in times like this, being able to get the job done and get it done right with vendors with good experience and good resources may really make or break that deal for you, and whether or not that deal is going to, make your portfolio look really good or drag performance down.
Yeah, for sure, 100%.
Any other comments on kind of the vendor side of things and inflation, material cost, anything along those lines before we move forward?
Well, one of the final things I'll just mention, just sort of going off of that, is that one of the sort of value propositions of buying turnkey rental property means that you are leapfrogging over all of that risk, right? Because you're not the one that is renovating the property, and you're not the one that is taking on the risk of those, either vendor or material costs fluctuating. So you're locking in your price, you're closing on a performing property. So it enables you to leapfrog over all of those upfront risks. So that's one of the value propositions that that our clients like about turnkey real estate, and that's one way to mitigate that risk if you're a real estate investor buyer.
Absolutely, thank you, Matt, for adding that in. Let me shift gears a little bit, and I'm going to start this question for Alex, but I think it probably spans across. And it said, is there a difference in strategy or benefit to buy and build versus buy already built? And the question came in from one of our listeners specifically on self-storage. So I know that's probably a pretty, there's a lot that goes into those two things, but maybe keep it a little broader in terms of, maybe being the developer versus going in and buying something that's already been developed. And we'll start on self-storage, and maybe we'll go around on other asset classes.
Yeah, so we are doing a development deal in Tallahassee, Florida. It was a conversion of an old YMCA, and then we're building additional 80,000 square feet around it. And so going on the repair cost side, things are costing more. Time is taking a lot longer to get permits approved and everything facilitated and done correctly. So on the build side, obviously you're creating a lot more value. So we're actually moving to phase 2 to actually build the 80,000 square feet, doing a raise for that. And the projections on that asset is, we're probably going to be all in at like right over 11 million. And after stabilized value, sell at probably around $18-19 million. So there's a lot of big profit to be had there, but there's also no cash flow during that time period. So, or very little cash flow, because we'll have one small portion of it. But typically on development deals, there's going to be no cash flow. So you're looking for a different investor who's willing to wait for those returns. Obviously, the returns are greater. This one's going to be looking at almost like a 30% IRR, but it's all deferred. So it's a little bit riskier investment, but it's going to be a greater payoff in the long run. The good thing about buying existing properties, which majority of our properties are existing properties, is the immediate cash flow. get immediate cash flow, immediate tax appreciation, principal pay down, all the benefits that Matt said. And so, we prefer, especially in this market, cash flowing properties. It is a lot more difficult right now to get investors to invest into assets that are not immediately producing income, and it's harder also to get the banks bank funding as well. So there are greater benefits if you can get it done. Like, we're already in this project already, so we have an added benefit of being in the market already, having the site plans and everything completed, where we can easily go into phase 2, where if you're showing a new development deal, it's probably a much harder proposition. And either, unless you can get the deal from the land for relatively cheap, or with seller financing, or partner with the landowner to alleviate some of those upfront costs that would be incurred by the investors, then I prefer to go with the existing portfolio deals that will provide immediate income and all the benefits of cash flowing assets.
So I'm going to add one follow-up question to that, and then I'm actually going to, Carrie, turn over to you and on the financing side. So I think Alex brought up some interesting points there. But I do want to dig a little deeper on zoning. That's come up a few times in some questions. So, two-part, right? One is the YMCA, was there zoning challenges, or was there some grandfather zoning in, and how would an investor go about that? And then number two, there's lots of parcels of land for sale, but how do you know or guarantee or ensure that you can get the proper zoning for self-storage specifically?
Yeah, so different areas are going to have like different zoning. Like, I think some of ours are like considered light industrial. Some of them are really zoned commercial. Some are zoned self-storage. And so it's different areas, and different counties have like different zoning for their area. But this one was the YMCA. It's on a main road, but it was vacant for many years. So the city was willing to be to accept it as a different option to be self-storage. So my partner on the deal, this is like his job is really finding land, scouting land, doing the entitlements. So this is a property that he had on his watch. He looked at the property. He knew it was a good location for storage. There was a lack of supply in that little area, and so he was able to talk with the city over a long period of time. He said, I think it's been over like a year and a half, working with the city to get it approved. And then once it was approved, then obviously we moved to the development side of it.
Awesome. Thank you, Alex. So Carrie, Alex brought up kind of the lending side and the challenges maybe in getting lending on a raw land development deal versus a cash flowing asset today. From your standpoint, from Ignite's standpoint, do you guys underwrite differently? What are some of the things that would make the underwriting for someone like Alex or anyone else, considering a development look better? What's more important in the process? So maybe just give us that kind of lender profile, if you will, on a development deal versus a current cash flow deal.
Sure. So first of all, asset conversions, from a lending perspective, at least from our lending perspective, we are very interested in. I know Alex was trying to find the right words there, but there's a lot of tax credits. There's a lot of cities that are looking to take these debilitated motels or hotels and get them converted into apartments because they have a desperate need in their community to have rental property available because they have, something new coming into their market, call it an Amazon, right? And all of a sudden they need 65,000 apartments for people to live in so they can employ them. And, those types of things, those real asset conversion opportunities, we are super interested in as a lender because there's value add just in the asset alone. Right? Some of us can come in and look at those motels and like, are you kidding me? Who in their right mind is going to pick that thing up? It's a roach motel. But in the same regard, you could easily pick that up. I'll give you, for instance, right now we have one. It was a motel. It was 85 units or so. I think it was 86 to be exact. It is being converted into studio apartments or one bedroom where they're taking two of the motel rooms and making it into a one bedroom. The lending, as we're looking at that as the value add, they purchased it for $4 million. And, purchasing that for $4 million versus building it would have cost about $11 million. And so for us as a lender, we look at that instant value add that they're creating, couple that with the municipality, city, or state tax credits that they're receiving by converting it, right? And easily converting it by giving them permission to say, please take this Roach Motel off our hands, get it looking like, a beautiful little gym in our community. And then we can afford to, bring in these other industries by proving that we have places for people to live. So, we're looking at the lending side of it, both on the macro and the micro, and figuring out what that community really needs and what value add is there. Because as a lender, we have to lend based on kind of that loan to own mentality. And I know that sounds awful, but you're a lender. So you have to consider, what is this asset going to look like if you have to take it back? Will you be able to, sell it? Will you be able to deliver it back to this market and have a buyer? So when we look at that underwriting, we're looking at it very differently from that conversion of asset type. So I would prefer to lend on something that has an existing structure. It's easier for us if we have to come in and finish the project, right? Because if I'm coming in at sticks, I've got a long way to go before I'm at the end of that rainbow for our investors. So yeah, we are looking at it a little bit differently. We love those conversion asset classes. We've done a lot of like commercial strip malls. During the pandemic, a lot of those were getting picked up. It was just, they had the wrong tenants in place. I mean, there is a time and a place for certain types of tenants. Your Rosses, your TJ Maxx, your lower end grocery stores, those sorts of things. There's always going to be a need for that. There's millions of Americans that don't have bank accounts, right? They're going to go shop in those types of facilities because they have to. They have no other means. They live paycheck by paycheck. So there's need out there. You just have to kind of look at it from, what's going on in that particular community, what's needed in that particular community. We can't always look at it as just the numbers. We do have to look at the end game of what the borrower is trying to create, make sure that it pencils out. And just briefly going back on the costs associated, I know it might be a little off topic here, but what we're actually seeing is the costs for our borrowers are coming down because they're locking them in. And that's a big thing for us as a lender, to make sure that the borrowers have those locked in costs, agreements in place for completion, what it's going to be. And yeah, do those vendors get pissed off because 6 months, 8 months go by and they're like, wait a second, I want to charge more, and then they try to some shenanigans with our borrowers? Of course they do. But get that lock-in price. It helps us as a lender to understand exactly what it's going to cost, because we're not going to lend 100% to you. So you're going to have to come out of pocket for this. So we're always looking at, does the borrower have the financial means to be able to finish the project? Because if I'm only lending 60%, where's the other 40% coming from? So it is a little bit different. Every project's unique. There is no one project that is the same for us, because we are in all different facets of lending, from commercial to residential. So loaded question, but yes, we definitely love the asset conversion side.
Okay. And just a quick deliberate question. Will you underwrite development deals as well?
Oh, absolutely. We do, from acquisition all the way through construction. Yeah, I always tell a funny story, from the home building perspective. You need to have land 2 to 3 years before you actually go vertical. And the banks are super willing to give you $100 million lines of credit, right, for the construction side. But who's going to provide them the financing to acquire the land that they need to build the houses on? That's why people like us exist. That's why lending groups, hard money lenders, that's why we exist.
Absolutely. Well, thank you. You touched on a very interesting perspective, especially on the conversion side. And one of the things that we talk about a lot when we talk about, hey, self-directing your retirement account is an opportunity to get in the marketplace. But one of the inherent differences between investing into real estate and investing into stocks is a level of social impact. And, if you can go into a neighborhood and you can buy a property and you can have it repaired and you can put it back on the market, yes, it is for profit, right? Make no mistake, you're doing it to make money. But you've just made the community all around it better. I was in Tampa yesterday, and I don't know if you guys know the Tampa market, but they've developed in the last 36 months just so much. And I hadn't been there, certainly with COVID, just hadn't had a lot of reason to travel. And if you're looking at the hockey stadium there, I think it's the Amalie Arena. There's a whole nother side to it that, in years past, if you were going to a concert or a game, you went from your hotel to the stadium and you went back to your hotel, or you stayed on that side of the arena. And now, you could go 360 degrees around it. And it's just amazing. And seeing the way that just a couple small redevelopment projects on stuff that maybe had been desolate or had been, an eyesore that's keeping people away is now flourishing. And it's great to hear some of these conversion projects that are taking some of these dilapidated buildings that have been around and have been collecting dust and Lord knows what else inside of them, and being able to turn them into living and creating an environment for people to have more affordable housing. It's an ecosystem that makes the community in which we invest better. So always love to kind of look at that. It's an often overlooked benefit of being a real estate investor versus maybe just a public equity investor. So one of the topics, this question's come up a lot, and in some of the feedback that we've gotten, just an overall opinion, and we'll go around. And Whitney, we're going to start with you if that's okay. We'll put you on the hot seat first. Inflation just missed yesterday, right? So still came in slightly higher than what was anticipated. Shake up that crystal ball of yours and kind of let us know from your standpoint, from an underwriting standpoint, from your current asset portfolio standpoint, what are you guys talking about or considerations that you're looking at as a result, not just of yesterday, but at least yesterday being the most recent sign that inflation's still a little bit of a thorn in our side?
Well, I think that's one of the beauties of investing in real estate is that you can actually position yourself. Matt did an amazing job, describing the 5 different ways that you can get paid in real estate. If you invest right, you are investing according to principles that it doesn't matter if the market goes up, down, or sideways, if inflation runs out of control. All these things can work in your favor. And so I really encourage, and this is something I had to learn, right? I grew up being spoon-fed that, stocks, bonds, and mutual funds is the only way to invest. I have to dump as much money as I can into my 401k. And it's just simply not true. So I really, learning to invest based on those principles for capital preservation, cash flow, equity growth, tax diversification, and tax benefits, really. Learning how to take safe advantage of leverage right now. I think that's the most important asterisk where people can go really sideways right now. And then investing in assets that it can hedge inflation, and that plays back to locking in that good quality debt, and then investing with expert operators that know their stuff, have the track record, the business knowledge and expertise, and the team in place to work on your behalf. Those are the principles that I think people should be paying attention to. Now, you did ask me for my crystal ball. That's what I do, right? Because I want to sleep well at night, and I don't want to have to worry about what the Fed's going to say, are interest rates going up or down. I want to be able to take advantage of that market, no matter which direction it goes. I think that, they've already indicated they're going to continue to bump interest rates at least 1 or 2 more times this year. Maybe it flatlines, maybe it goes down. I don't think the interest rates continuing to decline is the crisis in this moment. I think it's what happens when that poorly structured debt starts cycling out here towards the end of the year. I think that's the real opportunity for people. And if you're in a deal like that, if you have that type of debt, this is the time to get out of that debt, cut bait and go. So those are the, I think inflation headlines, they get clicks, they stoke fear, but it's really getting back down to investing principles and understanding how to mitigate that.
Thank you, Whitney. Some very good nuggets inside of there. I love what you said about like, this is what you do, and just because stocks, bonds, and mutual funds, is what people say. It's real. It's real assets that give you the best opportunity in all markets, not just up and down. I can't help every time someone says headlines. I think the hardest part about investing for probably 95% of investors in the marketplace is reacting. I know I'm a prime example. I'm not a big fan of the stock market. I've always bought and sold a few stocks, but I've always been in some form of real estate with all of my investable assets. And but I'm the guy that March 20th of last year sold Amazon, Netflix, and Apple. All three of them have since doubled. Like it goes to show that you can think you're smart, and chances are in the market you're just one headline away from a bad decision. And real estate, you can't react that way, and it is a little protect us from us. And you tend to realize that, yeah, probably looking back was a really dumb idea. But real estate gives that ability to move through the process. Back to Matt's 5 ways to make real estate or make money. You don't need every market condition to be great. Let's keep this crystal ball shaking going on. So Bryce, we're just going to go around. Bryce, what's your crystal ball on inflation, and what are you seeing, and how are you and your firm adjusting and adapting to it?
Well, as far as adjusting and adapting to it, I think actually we're thinking that with inflation possibly continuing to go up a little bit, maybe flatlining. I think that they will continue to bump interest rates, like Whitney said, maybe a few times here this year, 25, maybe 50 basis points. And I think, with that going into the future, maybe start to see a flatline curve, maybe some dips later part of the year. But for us, the way that we're analyzing any deal right now, we're pretty much chopping about 5% off of the ARV on the back end. So whether it's a single family, multifamily, or self-storage deal, we're saying, okay, based on super recent data, we're not even going 6 months to a year back. We're talking like 2 or 3 months back. We think ARV is around this range, and we'll just chop 5% right off of that, just to be really conservative in case of more inflation or increases in interest rates into the future to combat it. That we're positioned well enough in our assets that we've got some room so that we're not going to be underwater in anything. So that's kind of my little crystal ball and kind of what we're doing to combat it.
Well, it seems like a very smart approach in terms of just clipping 5% off the top, and that's the unaccountable variable. That's chalk that up into the hope you're wrong category. And on the closing statement at sale, there's a 5% that you weren't accounting for that worked its way back on to the settlement statement. So love hearing just some little tidbits that the folks listening can take away with them today. All right, Matt, you're up. Shake that crystal ball and tell us what the world looks like.
Yeah. So first of all, with regard to mortgages, the thing to remember is that as a mortgage borrower, if you are locking in a 30-year fixed rate mortgage, you are in the driver's seat. Okay. So most of the preferred lenders that we work with think that interest rates will probably dip at some point later this year. If you lock in a mortgage today, then when those interest rates dip, you can refinance at a lower interest rate. Okay. If, on the other hand, interest rates go up, the other person is stuck with it for 30 years, right? So as the borrower, you are in the driver's seat. When they go down, refinance and lock that in. When they go up, just hold what you have and the other person's stuck with it. So keep that in mind. You are in the driver's seat when you are borrowing. So as long as you're locking in a mortgage where your monthly payment plus all your operating expenses and everything else is lower than your gross rent, so that your gross rent covers it all and gives you a positive cash flow, then you always have the future ability to refinance and get a lower mortgage and reduce your expenses if and when those interest rates go down in the future, right? So that's the first perspective. And then, as I mentioned, with regard to inflation, this is really, 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 really important to understand. If you have your money sitting in a bank account in cash, inflation will destroy your wealth and it will destroy your buying power. If, on the other hand, you take that money and you buy and hold a residential investment property, you have moved to the other side of the inflation equation, and you are now positioned to profit from inflation, which means the higher inflation goes, the more you profit. Home prices rise with inflation, rents rise with inflation, and inflation destroys your mortgage debt because you're paying it back in future diminished nominal dollars that are worth less than the ones that you borrowed, right? So understand that in periods of high inflation, if you're holding residential investment property, you are actually profiting from that inflation instead of losing to it.
Yeah, love that perspective on combating or reducing the actual cost of owning that mortgage. I did see Carrie give a quite a nod when you mentioned kind of the being in the driver's seat, and I think it's one of those things that actually does work for both groups. A refinance isn't the worst thing that ever happened from a lender standpoint. It gives them back their capital and allows them to redeploy it, and maybe even reduce their cost of capital. So it's one of the few times where you can make a decision today and fix the decision later. What you can't fix is this decision to be in a floating rate typically, and find ways to reduce that. But refinance is I think probably a buzzword over the next 3 to 5 years. We're going to hear a lot as being an exit strategy. We're in at 6 and it's cash flowing well. What would this deal look like if we underwrote it or refinanced down to 5, 4, 3, depending on what rates do. So thank you, Matt, for adding some perspective. So we'll keep going around. We've got 2 more perspectives. Alex, get that crystal ball shaken up. What's going on?
So I don't think we're out of the worst of it yet. I think there's still going to be a lot of people impacted. Like I think Carrie or Whitney said, there's still a lot of commercial properties that the loans are coming due, and probably everybody underwrote that they're going to exit at a 4 cap or refinance at this number, and that's not going to happen. So there's still going to be a lot of things hurting. Obviously, you see like a lot of people also laying off, a lot of layoffs going on, and so that unemployment, those loans coming due in the commercial side, a lot of multifamily. I think there's going to be some opportunities for investors. And so what we're doing and have done is we're selling some of our assets, looking at our return on equity and seeing that, we created so much equity on these deals, so much add value on these deals where our cash flow we're getting is maybe 2-3% compared to the millions of dollars we created equity. So we're selling these properties because there's still a lot of money out there that's on the sidelines ready, that's looking to deploy. So they're not eaten up by inflation. And so you can still get a good pricing on putting your properties out there on the market. So we're selling some of our stuff to like private equity firms and some of our storage deals and taking those funds and being ready for those new opportunities coming ahead. And we're buying right. We're looking to buy great deals, good numbers. We can get creative finance opportunities. We can get low debt on good terms and have higher rates of return and higher cash flow on these bigger and newer assets. And so we're trying to get as cash heavy as possible. We've sold a lot of also like our single family houses in like in the lower income areas, and we're really just going all in with creative financing. I've been doing creative financing since 2017, bought a lot of my properties, my portfolio with creative financing. This will be the third self-storage we bought with creative financing, and it works in any asset class. So I think if you're not utilizing creative financing, that's something that you should do in this market. It allows you to make these deals pencil out and allow you to cash flow, and you need cash and cash flow to survive a recession.
Thank you, Alex. So, you're taking the fill the coffer approach with as much cash, get as much cash off the table, looking to put it back on the table as quickly and efficiently as possible. So, awesome. Well, thank you, Alex, for sharing. All right, Carrie, bring us down the home stretch here. You've got your crystal ball all shaken up. You've had the most time to shake it. So, what are we looking at?
So there's one thing that nobody's mentioning. typically when you have inflation, spending goes down. What are we seeing happening? People are spending more than ever. Think about this for just a second. So I'm a little bullish on this, maybe more so than others. But what I'm seeing as far as inflation is people just keep spending and spending and spending and spending. And I'm waiting for that moment where people start pulling back. And I'm not seeing a ton of that happening. And the prices just keep going up and we just keep spending. So when I say I'm a little bit bullish on this, I get asked a lot of times about this crystal ball. And what is recession-proof investing? What does that look like? And do we provide it? And, one of the things that we have to do, all of us in real estate have to do, especially when we're offering investments to investors, is we need to make sure that our portfolios, what we're responsible for and what we're providing to investors to invest in, have really been well thought out in taking into consideration. I think everybody on this panel probably lived through 2008, well, let's say you lived through the 2000s, okay, thus far. There have been good times, there have been bad times. There have been times where we've invested in real estate and we had to hold it for a considerable amount of time. As a lender, there have been times where we have had to make some concessions, let's say, in order to maintain the integrity of the asset itself and the lending strategy that we originally created with that borrower. So yes, I hear inflation. Yes, I hear all the headlines. I still keep seeing us dumping money into all of these things. So people just keep spending. So the word inflation to me, it hasn't quite resonated because usually spending pulls back and I haven't seen that. But from a perspective from Ignite Funding, our crystal ball says, be a little kind to borrowers right now. They too are looking for ways to refinance their way out of our higher interest rate lending, and they're having difficulty doing it. It doesn't mean that the value of the asset has deteriorated. It means that their ability to get it refinanced has deteriorated. So as a lender, provide them opportunity, give them more time. We're doing it by offering investors the opportunity, or the borrowers, the opportunity to forbear paying off their loans right now. It doesn't mean that the investor is not continuing to receive their interest on their loans. It doesn't mean that at all. They're still paying the same interest rate because remember, our interest rate's closing in. It's just giving them an extended period of time to find the right takeout financing. Because you don't want to get ourselves in the situation we were in 2008, where we have these, arms and, 2 years down the road, 3 years down the road, 4 years down the road. These are borrowers we expect to have for 20 years. We need to set them up and help them succeed. So in the future, when interest rates maybe do taper off or do start going down, that we're still there for them and they're in a good financial position to continue to pay on the loans that we have with them, as well as the loans that they've gotten refinanced. So keep that in mind. Be patient. This is a patience game. Recession is, this isn't a 3-month cycle. This is typically a couple year cycle. So we all have to be prepared for it. I think we're already in it. I have felt that for probably 6 months, maybe 9. At this point, which is a good target to say, hey, if we're halfway through this, we're not doing too bad. We're not doing too bad. Be smart about it. Don't let your money sit in cash. I agree with you. I think that's absolutely ridiculous. Get yourself invested in something that's collateralized. I'm even going to go out on a limb and say, if it's not real estate, do something. Do something. Whether it's precious metals or whatever it happens to be, get in something that's collateralized. We all love real estate. Everybody that's listening right now loves real estate. Everybody that's on this panel loves real estate. The reason why we do is it's been a consistent investment over a long period of time for us personally. We know it works. We know if you hold it, you can get through catastrophic times, recessions, pullbacks in the market, inflation, whatever you want to call it. Real estate is resilient to it. You just have to be patient with it. So be patient with your borrowers. Don't be patient by letting your money sit on the sidelines. Get it invested in real estate. It will withstand this recession. Crystal ball, I know. Invest. It works. Real estate, it's a long-term play.
Yeah, and sorry, Carrie, I didn't mean to cut you off there. That last comment, I think we'd all agree there's no crystal ball required to let people know the way to get through any sort of inflationary period is to not let your money sit. It's the most dangerous thing, even though it's the thing that most people think is best to do. You know, you brought up, and I'll kind of wrap us up on something that I appreciate you bringing up: spending. You know, it's interesting. There's a million and one economists. Some are by design, some are by accident, and eventually everybody's comments will be right. If you say enough things, you'll get there. So we're all really smart eventually. So we'll look back on this in a few years, and I'm sure a couple of the comments made are going to be very enlightened comments, and the other ones maybe will be forgotten about. But spending is an interesting one. It's one that is really hard for me to put into understanding against where in the potential recession. And I do agree with you, right? We probably are already in it. Nobody ever knows until you're coming out of it or until it's deep enough, that you're actually in it. But, spending is one that it just hasn't subdued. And it's amazing because stuff has just gotten absolutely so unbelievably and obnoxiously expensive. And nobody really bats an eye. Social media makes a big deal about eggs, but eggs is just a small item. I know someone that has a car dealership, and their family's had it forever. It's one of the big branded names, and I was chatting with him about what is this doing to you guys? You got no inventory, all of this stuff coming out of COVID, and he says we're making more money than we've ever made. He said, we used to sell 200 cars with a staff of 25, and, we were always grinding it out to get to 201 and 202. He's like, we sold 35 cars last month, and I made more money last month selling 35 cars than I did when we sold 200. And when you hear that, for me, my thought is businesses aren't following inflation. Businesses are following profit. And deflation, to me, is going to come when consumers stop spending. It's not going to come because of interest rates, and it's not going to become because the marketplace demands it. Buyers are still buyers. People are still spending. You guys own asset classes that I'd imagine for the most part are still yielding premiums. And until investors or buyers or whomever the marketplace is slows that down, if ever, something's going to have to change. So there's my two cents. And I didn't really think much about that till you brought in the spending piece. It's really an important attribute in what the actual state of affairs of our economic situation is and will become. So, I want to just pause and say thank you. Whitney, Bryce, Carrie, Alex, Matt, you guys are true professionals. Talking about some of the topics we did helps at least me realize the depth and scope of your knowledge. And I know the people listening today and in the future are going to benefit gravely from the expertise that you guys have shared. So thank you so much for being here.
Absolutely.
If you,
of course, thank you.
Any of their individual presentations, they are all available on our website. So you can certainly rewatch this at any time, but you can also go back if you weren't able to catch each of the individual items, please go back and take a look. The content is absolutely incredible. We've got a whole lot coming up here at NuView. We'd encourage you to take a look at our website and look at the events that are upcoming. A couple big things to share. Probably the biggest thing that we're most excited about is we'll be launching our very own podcast. We've got so many great people that we work with every single day that have so much great knowledge. Forums like this are wonderful, but we're going to even up the ante on education in today's marketplace with our podcast. So look for that to drop in early March. I'm sure there will be plenty of marketing info sent out or made available for you. The second thing is we're putting the finishing touches on our investor retreat. So that's an annual event that we do. We held it last year in January, so it's been a little bit of time, but we're excited to hopefully in the coming days and weeks. Have a date in the latter part of the year for that, which is just another great opportunity to network with like-minded investors, people that are out in the trenches every single day, whether they be folks like the individuals on the call who help investors make more money, find deals, provide investment opportunities, or whether it's a do-it-yourselfer that loves the idea of going out and doing a couple investments this year, but they don't know what they don't know. And I'm a big believer that surrounding yourself with like-minded professionals, getting as much info as you can is just going to allow you to learn the lesson from someone else's experience, which is the best types of lessons to learn. I think everybody here would agree. The lessons where you get the experience and lesson at the same time tend to be the most painful, but they also tend to be the ones we seem to remember the most. So with all of that said, we're going to conclude today. Thank you to our panelists for being here and being willing to lend your time, effort, and expertise. We really appreciate it. And to everybody joining us, thanks so much for working on getting a bit more information. And hopefully you got some nuggets today that'll help you go out and be a better investor and hopefully be a better self-directed retirement account investor. So thank you guys all.